Most markets go through a cycle. First, there is despair, then hope, followed by growth. The final phase is optimism. After this, the cycle repeats itself. Now, despair is the phase when markets experience a significant correction. It often occurs when the country's economic growth faces a setback due to some event. We saw this at the start of COVID-19. Investors expected earnings to take a hit due to slowdown in the economy. Then comes hope, the strongest and shortest phase. During this phase, markets and valuations rise, anticipating a growth in future profit growth. Investors chase quality companies with strong fundamentals. Now, once this economic event is past us, comes the growth phase. During this, profits recover, but returns moderate. That's because the earnings are already factored into a stock's market price during the hope phase. The final phase is optimism. This is when investors make the best returns and valuations turn expensive. Optimism turns into euphoria. At this stage, returns are the only things on investors' mind. Low quality stocks and companies with weak fundamentals also see their stock price go north. Comparatively, quality companies look attractive at this stage. Now, based on the cycle, we are clearly in the optimistic phase. Sooner or later, markets could see corrections. Now, this could be the right time to add quality stocks to your portfolio. Hello and welcome to ED Money's YouTube channel. In this video, we will discuss how to add quality stocks to your portfolio using mutual funds. So when the market cycle turns, you will have schemes in your portfolio that perform better than the broader markets. We will analyze large, mid and small cap index funds focusing on quality stocks. They are also called factor funds. Alright, let's begin. Motilal Oswal Mutual Fund has done an interesting analysis. The fund house looked at different investment strategies that work during the bull, bear and recovery periods. For this, the fund house examined the performance of 4 different factor indices. These include the BSE Low Volatility, BSE Enhanced Value, BSE Quality and Nifty 200 Momentum 30 indices. During bull markets, the Momentum Index worked the best, followed by Value. However, Quality and low volatility indices performed best during the bear phases. The third phase they examined was recovery, which happens once the bear phase is over. Here value, quality did well. Now this analysis again shows that quality could do well in the next market phase. The fund house also looked at the yearly performance of different factor indices. No factor has performed consistently well year after year. Between 2021 and 2024, value has been the best performer. However, value was at the bottom for the previous 3 years between 2018 and 2020. This shows different investment strategies work during different market phases. So, instead of chasing the best factors, investors should look at the most consistent factors. Now, if we examine the top performing factors year after year, quality and momentum were the top 2 performers in 9 out of 16 years. Value was among the top 2 performers 8 times in 16 years. Low volatility was in the top 2 only 6 times. Now, as we looked at the best performing factor indices, we also looked at the worst performers. This is the area that investors would want to avoid. Momentum came in at the bottom 3 times in 16 years. Value and low volatility ranked last 6 and 5 times respectively. Quality, however, did not rank last in any of the 16 years. Now, if we combine both the underperformance and outperformance data, quality turns out to be most consistent. It has never been the worst performer and has been in the top 2 most of the times. So clearly investing in quality companies can reduce your chances of underperformance and help you generate good returns on your investments over the long term. Now, one good thing about consistency is that you don't need to worry about performance in different market cycles. Next, let's look at the performance of different quality indices and analyze which one can you consider if you wish to add quality to your portfolio. I know we have already talked about quality for a few minutes, but we didn't discuss what quality is. Generally, quality means companies with sound fundamentals. However, the BSE and the NSE approach quality differently. Both have quality indices. Let's understand NSE first. Now, NSE shortlists companies on 3 parameters and assigns a quality score to them. It selects the companies based on this quality score. The 3 matrices are return on equity, debt to equity, and consistency in EPS growth. In the case of finance companies, NSE only looks at ROE and EPS growth. Now, this approach of assigning quality scores helps shortlist companies with consistent profit growth, good returns on equity, and the ability to survive harsh market conditions due to low debt to equity ratios. However, there is one drawback of this quality definition. Capital intensive businesses use debt to finance their capex. This results in a higher debt to equity ratio and a lower quality score. So many of them may miss the index, but that's the NSE's way of selecting quality companies. The process BSE follows is similar but with one key difference. BSE Quality Index also uses three parameters to assign a quality score. The three matrices used are ROE, financial leverage, which is similar to debt to equity ratio, and accrual ratio. Now the accrual ratio is different in BSE. Now this is a bit technical. The accrual ratio tells us the proportion of earnings that come from non-cash activities. A high accrual ratio may indicate that the company's earnings rely more on accounting decisions and less on actual cash flow. Now this metric also helps in evaluating potential earnings manipulations or lower earnings quality. Unlike NSE, the BSE Quality Index doesn't follow a different methodology for shortlisting finance companies. Alright, that's the definition of quality for BSE and NSE. Let's now look at the performance of different quality indices. Now there are 5 pure quality indices, 1 from BSE and 4 from NSE. Apart from these, there are 5 more indices that use the quality factor. However, we did not consider them for the analysis because they are not pure quality indices. Among the 5 pure quality indices, Nifty 100 Quality 30 focuses only on large cap stocks. It picks 30 quality companies from Nifty 100. The Nifty 200 Quality 30 focuses on a mix of large and mid cap stocks. The BSE Quality Index is similar. Now the other two indices are Nifty Mid Cap 150 Quality 50 and Nifty Small Cap 250 Quality 50. Both select 50 companies from their parent indices. Now to analyze the performance, we will compare each index with its parent. For example, let's compare the large cap quality index with Nifty 100 over different time frames. Now if we look at the trailing returns, we see that the quality index has performed better than the Nifty 100 except for the 10-year period. Next, we looked at the rolling return of this index between October 2009 and September 2024. The 5-year median rolling returns of this index was 13.74%, whereas the same for Nifty 100 was 13.34%. The 7-year median rolling returns were the same at 12.85%. So return-wise, the difference in performance is not huge. This could be because the top 100 companies have good earnings growth and stable capital structure. So cherry-picking 30 stocks from the large caps did not make a huge difference in the performance of the index. Next, we did a downside protection analysis. We looked at the quarters where Nifty 100 generated negative returns. There were 18 such quarters. When we compared the performance, the Nifty 100 Quality 30 did better in 17 of these quarters. So, even if the difference in returns is not huge, the Nifty 100 Quality 30 index has better downside protection than the broad market index. Now, if you want to invest in Nifty 100 Quality 30, there's an index fund by Edelweiss. Next, let's look at the performance of quality indices in the large and mid cap space. Here, we have two options, the Nifty 200 Quality 30 and the BSE Quality Index. To evaluate the performance of these two indices, we use the performance of the Nifty 200 and Nifty Large Mid Cap 250 Index. Now, if we look at the trailing returns, the BSE Quality Index has done the best in almost all time frames. It has outperformed Nifty 200, Nifty Large Mid Cap 250 and even Nifty 200 Quality 30 Index. The performance of Nifty 200 Quality 30 was a mixed bag. However, over 15 years, it has done better than Nifty 200 and Nifty Large Mid Cap 250. Next, we check their 5 and 7-year rolling returns. BSE Quality Index has done the best in 5-year as well as 7-year time horizon. If we look at the Nifty 200 Quality 30 Index, its 5-year median rolling returns are better than those of both benchmarks. In terms of 7-year rolling returns, the index has done better than the Nifty 200, but its performance is similar to that of Nifty Large Mid Cap 250 Index. Now, the BSE Quality Index has not only done better than others, the margin of outperformance is higher. On the other hand, the Nifty 200 Quality 30 has outperformed Nifty 200 by good margin, but its performance is at par with the Nifty Large Mid Cap 250. We also checked the downside protection in comparison with Nifty 200. There were 19 quarters when Nifty 200 gave negative returns. Of these, basic quality has done better in 16. Nifty 200 quality fared better in 15 out of 19 quarters. So the downside protection of both quality indices is similar. Now this large and mid-cap space is probably the best option if you want to add quality to your portfolio. You can choose the best stocks from the top 200 companies representing over 80% of the free float market cap of all listed stocks. For the BSE Quality Index, there is one index scheme by Motilal Oswal Mutual Fund. For Nifty 200 Quality 30, UTI Mutual Fund has launched a new scheme. The NFO of this fund will end on 16 September. Next, let's look at the performance of Nifty Midcap 150 Quality 50 Index. If we look at the trailing returns, the Nifty 50 Quality 50 Index has underperformed the Nifty Midcap 150 Index over most time frames. But if we look at the 5 and 7 year rolling returns, the Midcap Quality Index has done better. So the poor trailing returns performance could be because of recent underperformance by the Nifty 150 Quality 50 Index. The Midcap Quality Index also did well when we looked at the downside protection. Of the 22 quarters when the Nifty Midcap 150 had given negative returns, the quality index fell lesser in 18 quarters. So using the quality factor to cherry pick mid-cap stocks has worked quite well. Now there are index schemes from DSP and UTI Mutual Fund that track the mid-cap quality index. Lastly, let's look at the small cap space. Here we have the Nifty 250 Quality 50 that picks 50 quality stocks from Nifty Small Cap 250. The Nifty Small Cap 250 Quality 50 has done better than its parent index when we check trailing returns as well as 5 and 7 year rolling returns. In rolling returns, the margin of outperformance is more than 5 percentage points, which is quite significant. Now, investing in small cap stocks using quality has definitely worked in favor of the index. Next, we'll look at the downside protection of this index, and even there, the quality index has done better. It fell lesser than the Nifty Small Cap 250 in 20 out of 21 quarters. So besides higher returns, the small cap quality index also has better downside protection. Now many investors opt for active funds in the small cap space, as most have outperformed the Nifty Small Cap 250 index over the long term. However, if you want to invest in this space passively, the small cap quality index looks like a good option. Now, if you wish to invest in a small cap quality index, DSP Mutual Fund offers an index scheme. With this, we move to the last section of our video. Data shows that quality indices have done better than their parent indices. So if you wish to invest in a factor that can generate good returns consistently and don't want to time your entry, you can explore these funds. Also, whenever we enter into the next phase of the market cycle, quality could do much better than other strategies. So it might be beneficial to explore this strategy. However, know that this is not a buy recommendation. You should look at your overall portfolio and then make any investment decision. And with this, we have come to the end of this video. I hope you found this video helpful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.